today's world, the opposite's true. So, it's really hard to get any attention on the B2C side, and usually have to have a fairly large marketing budget to start to attract users and sort of test user acquisition and see what churn is. And on the enterprise side, on the B2B side, it's usually less expensive to build and actually start selling because you don't need that marketing budget. You can start with just outbound.
This is another episode of the Form Your Own Impact podcast with my guest today, Dave Lambert from Rightside Capital, and he is in San Francisco. Dave, how are you doing?
I'm doing great. Thanks for having me.
It is Rightside, right? It's not right.
Correct. Rightside Capital.
All right. So for people that don't know, who is Dave Lambert?
So I'm one of the founders, managing directors of Rightside Capital. Been doing this for the last 15 years. And prior to Rightside Capital, I was basically a career entrepreneur. So graduated college in 1992 and then founded and ran two different tech startups, one a computer hardware company, and then one sort of .com software company over the next 17 years. And Rightside Capital is really, I sort of look at it as my third startup. So we're sort of, we view ourselves as a tech startup whose business is funding other tech startups, and been loving it. Doing some innovation on the funding side of the fence.
So what was that motivation like to start Rightside after being an entrepreneur twice?
Yeah.
Bit of a change.
Yeah. The genesis for Rightside Capital came from one of my two partners, Kevin Dick, and basically, we are a quantitative, data-driven approach to very early, what we call pre-VC stage investing. So we're investing in rounds that are usually too small for seed and pre-seed venture firms to address. Typically, when companies are raising $100,000 to $500,000 rounds. And I knew from being both an entrepreneur over the last 15 plus years and having been an angel investor on and off for sort of a decade plus, that segment of the market was really inefficient and dysfunctional and didn't work that well for participants on either side of the fence. So we came up with a method where we could gather up a bunch of quick data points or a bunch of data points on a company and make very quick decisions. So we usually make decisions in just a few days. And we thought that would be good for us as a firm and allow us to build ultra diversified portfolios. And that also would be exactly what entrepreneurs needed. It's sort of filling the void for the segment of the ecosystem that needed funding the most.
So when you say quantitative, obviously if they're early stage, it's a little tricky because it's a new entity. What are you gathering data points on? Is it the founder or the sector?
Yeah, it's changed a little over time. So back when we first started investing in 2012, we were primarily investing in pre-revenue companies, sort of 70% were pre-revenue. And it was mostly about the type of business model, perceived unit economics in the future, and a lot about the founding team and the founding team's history and sort of skill sets. And then we happened to be in the right place at the right time, and the costs to develop a software product collapsed over the last decade.
Big time.
Where it's really zero if you're a technical founding team. And so now most of what we invest in already has some revenue, usually anywhere from 5 to 25K a month in revenue. And so we're looking at things like, what is your actual traction level? What are your unit economics? What's your average price point? What's your growth curve? How much cash have you raised to date? What's your burn? And then still a lot of things about the founding team, skill sets and, and experiences of the founders as well. And we suck that up and generally make a decision very quickly.
It makes me think that, I know, how Y Combinator kind of came up with very standard set of documents, for example, obviously methodology. And I was kind of looking at your site. Have you kind of done something similar with achieving those metrics? Like, are you kind of pre-advertising, this is how you should structure yourself? or is it more like you're analyzing against your criteria?
Meaning this is how structure as far as the investment goes, or how the company should be structured?
Yeah, well, I mean, I'm not saying legally, I'm just saying, because you're obviously comparing it against this criteria. Do you kind of pre-signal what that criteria is?
Oh, yeah. If you go to our website, so it's not the case that there's just one ideal profile of startup that we're looking for. There's a whole, there's a large number of different profiles that are attractive. If you go to our website, you can go to rightsidecapital.com and click on the submit button up top. We spend that entire page is all about what our target investment profile is. So we try and be as transparent as possible. So any founder can go there and read about what we look for and tend to fund. And then if you think you're a good fit, you can fill out the pre-screening form at the bottom, and we actually respond to 100% of companies that fill that out, and we respond pretty quickly.
I'm going to share my screen for 1 second, which is your website.
Yeah.
I don't know how many VCs or investors start off with a cartoon, but this was a unique, novel approach, I thought.
Yeah. It's part of which, we were sort of a solution for what we perceived as a slightly sort of broken model for investing from the entrepreneur's perspective.
Love it.
And yeah, those have been there for a while.
Well, it's very transparent and clear, and this is what I kind of recalled before I pulled it up. But so it's worth checking out there. So what are some of the sectors or companies that you're excited about right now?
Yeah, in general, we're funding, I would say 75% or so, maybe 75 to 80% of what we fund tends to be B2B SaaS businesses, with the other 20 to 25% a mix of almost everything else, whether it's B2C business model, marketplaces, a little bit of transactional business models, or something that's just recurring but no sort of not contractually recurring. And I think that's one of the things that's changed over time. When we started, if you go back to the beginning of the 2010s, it was probably cheaper at that point in time to build a consumer product. There was not as much noise. If you got an article written in TechCrunch about you, you got tens of thousands of users right away.
Right.
It was more expensive and took a lot more capital to build an enterprise product. And I think in today's world, the opposite's true. So, it's really hard to get any attention on the B2C side, and usually have to have a fairly large marketing budget to start to attract users and sort of test user acquisition and see what churn is. And on the enterprise side, on the B2B side, it's usually less expensive to build and actually start selling, because you don't need that marketing budget. You can start with just outbound sales. So we've, I think, moved more heavily B2B focused over the last decade as that trend's played out.
So I mean, one of the tenets that we try to evangelize is, rapidly prototype and then go talk to real customers. So I think what you're saying is that you validate that those are the types of businesses that you're looking for. Is there a limit to that? Like, obviously people can knock out a product that's at least somewhat functional, right? And can put customers on. When you say B2B, are you finding that those B2B direct sales are more to smaller companies, or is it legitimately enterprise size?
Oh, legitimately enterprise size too. It's a mix. We'll do ones that are selling to smaller businesses. I think it's a lower bar to get us of traction that you have to have for us to fund your company if the price point is high enough that it can comfortably support a sales force. So if you have a $1,500 a month product, or $15,000, it easily supports a sales force. Usually $500 a month does as well. Once you start getting down to $300, $200 a month, you have to have a very quick sales cycle to really support a sales force. Otherwise, it really needs to be inbound marketing driven. And so those businesses can succeed, but it's just harder to get them to work, because you really have to get the math and the user acquisition down through marketing dollars, and that's just harder to do. So it's not that we won't fund those. I think it's just a higher bar to get us to buy in that your marketing math works.
That makes sense. So in other words, can be outbound products got to have enough monthly recurring revenue per unit or per customer to make it worthwhile, a reasonable cost of acquisition and time.
Yeah. And I think what I'm just saying is sort of the middle 70 to 80% of what we fund. There are companies that we come across that are exceptions and are making, certain unit economics or business models work that, wouldn't for most startups. And I wouldn't recommend a founder necessarily go and launch a business based on that, but for whatever reason, they're making it work and they've sort of caught lightning in a bottle, and we'll still fund those as well.
So there seems to be a lot of B2B products out there, and some are directed at sales, some at marketing, some at support. Is there any segment that you think is actually growth, or is it just that people understand these tools and they're looking for alternatives? What are you seeing out there right now?
Yeah, I mean, I think the big change that we've seen in the B2B SaaS market over the last decade is that 8-10 years ago, it was really difficult as a young startup to even make a sale to mid to large size companies because they were so hesitant to buy from a startup. People were worried they would get fired if they started using your product and you went out of business. And so it's just really long sales cycles and a real uphill battle. And I think that entire culture it has changed inside mid to large size companies. So they're all used to buying SaaS products. They're all used to the fact that they can try and experiment with SaaS products. And if one that they try doesn't work out, they can stop using it and no one's going to get fired. And so the barrier to get a contract and to be a young company with even no customers and to get a mid or large size company to try you out and start paying you is lower than it's ever been. So it's really much, I wouldn't want to say it's easy, but it's much easier than it ever has been to get those initial sales as a startup. And what companies need is always changing. And the startup products, the software products of 8, 10, 12 years ago already seem, outdated, and
Absolutely.
The functionality isn't there. So there's just, it's not the case that we get to a point where just every problem's been solved by a piece of software and there's no new problems to go after. There's always dislocation. There's always, replacement and new functionality, that exists in new products.
That's great feedback. All right, I'm going to wrap with a few quick questions. One, if you could give advice to founders designing new products, what would that be?
Yeah, my advice would be that, stick with the roots of lean startup. And I think that lean startup techniques were very in vogue and popular going back at the 2010 to 2015. And then I think people started not using them as much as the cost to develop a software product got so inexpensive.
Which is weird because it would be the other way around.
I think what happens is people don't really like calling out and doing interviews with 20, 30, 40 potential customers. They, and if it's going to cost $1 million to build a product, well, I better make sure the customer wants it beforehand. But if me and my 1 or 2 technical founders can just take 6 months of our time and build it, and we're pretty confident this is what the market wants, I'll skip the pain of those calls and just build it. And that happens far too often these days. And I think at the end of the day, if you build a product that's really market driven, you do that initial research, find out what the pain points are you're trying to solve for, get a customer using your product as quickly as you can, and iterate from their feedback. That was the best practice 10 years ago, and that's still the best practice today. It's just not done as often.
It just seems so counterintuitive, but I think that's what it almost feels, maybe to your point, it's like, hey, it's just time. It's like, it's time to build it, not cost. It's like, I can just build it. And then
everyone's got time, so.
That's interesting. Whereas you could build a product and then iterate cheaply, which would make more sense, right? And it's good feedback too, because I think what I see is people doing the Swiss Army knife approach as opposed to the really focused functionality like that lean startup says around it. It's like the word MVP has become a word that doesn't really mean what they meant it to be.
Yeah. I think there's sort of 2 or 3 major things that have changed or people have got wrong and that are terms sort of from the lean startup movement. One is sort of what is an MVP and what do you do with it? But I think the biggest one is product market fit. People these days, the term product market fit is used to mean we've got a product and we're selling it, someone's buying it. But that isn't actually what product market fit is. You can have a company that has 1-2 million ARR and doesn't have product market fit. In fact, a lot of them don't. Product market fit is when your product meets the need or a pain point of your target customer so well that your target customer is almost pulling the product away from you. And the sales cycles get that simple and easy. And you have a meeting with the customer And as soon as you're 60 seconds into your meeting, the person says, hold on, and they go out and they bring 1 or 2 more people into the room because you're solving a pain point that they've been talking about. That's product market fit. I think very few startups ever actually get it. And 95% of startups think they have it when they don't.
Well, I agree with you there, because we've asked a lot of people, just talking to them in this format, what's product market fit for you? And the answers are very different.
Yeah.
They're all over the place.
Yeah, and I would think that even most investors these days, a lot of them even
Maybe.
throw around the term product market fit, just meaning, all right, if you're selling and you've got a certain amount of revenue traction, I believe you have it. But
Interesting.
we'd set the bar much higher.
Yeah, but I think what you're saying is very clear. And someone actually describes, the only person I heard describe it similar to you is, they said, when you're so busy and you're growing so fast and you can't keep everything in order, it's like the demand is outstripping your capacity to handle it. So I think that was kind of similar to what you were saying, where it's like the product kind of sells itself. And
you go to sleep at night, waking up with nightmares like, oh my God, how are we going to fulfill all these orders?
yeah,
right?
it's not
that's
exactly
actually product
that's
market fit.
I think that was a Y Combinator founder. I'll go back and look at what it was. I can't remember.
Okay.
He was like on the money. All right. If you could give only one piece of advice to founders, it could be in any area, whether it's pitching or starting or building a product or sticking with it. What would that advice be?
My piece of advice these days would be to keep your cash burn low for a much longer time than you would intuitively feel you need to. So what we find is a lot of companies, as soon as they start to be able to sell their product, want to raise a lot of money, start burning a lot of capital, scale out sales. And there's a couple things wrong with that where companies get in trouble. One is, if you're not selling the product and don't have a good, repeatable sales process that you can do as the founders, you're not going to successfully train other salespeople under you to do it. You're going to hire them and they're going to fail, not because of them, but because of your training methods. And number two, this is the biggest, early on in your life cycle, even once you started to sell, it's very rarely the case you've got an optimized product and an optimized feature set, and you might not even have the right product at all for your customer base. And what we find is that companies that have higher cash burns tend to get blinders on. So if you're burning 80 or 100,000 a month and you got 5 months of runway, you have no choice but to make your current business model work to try and get enough traction to raise a decent sized round. Because no one's giving you 200,000 when you're burning 100,000 a month, give you an extra 2 months, and it's hard to raise that extra million. On the flip side, if you have that same level of traction and you're burning 20,000 a month, and all of a sudden in talking with your customers, you realize, hey, 8 of our 20 customers have this other problem they're talking to us about, and it's 2 or 3 times more of a pain point than our current product. And we could build something to fix that, and they'd probably pay us twice as much. You might notice that, and you might throw out what you're doing and pivot to that, because you're only burning 20K a month. You got 5 months of runway, and if you raise another 200,000, that's another 10 months. And so you naturally have your eyes open, you naturally iterate more on your own product, and you naturally pay attention to other opportunity when you're not burning those crazy amounts early on in your life cycle. And I think people don't realize that so much of the value in early stage companies is optionality. Just being alive with a business model, generating revenue, and having active customers that you're talking to gives you so much optionality to discover something even better and more valuable than what you're currently doing. And the higher your cash burn, the less you will pay attention to that and take advantage of that optionality. So it's a long answer, but
no, that's great advice.
My number one piece of advice.
That's very helpful. Thank you. All right. First of all, thank you for your time today. I really want to acknowledge you for putting out your philosophy. And how do people who want to get in touch with you get in touch with you?
Yeah, if you have just a specific question for me, you can reach out via email. My email address is dave@rightside.capital.com. You can also go to our website if you think you're a potential investment fit for us, as I mentioned, and read our submit page. We put all our investment criteria there, and if you think you're a great fit, please fill out the form and we will follow up with you pretty quickly. And as I mentioned, we tend to give companies a very firm yes or no, usually in less than a week. And if it's a no, we'll always tell you exactly why it's a no. And if it's a no because you don't have enough traction, or we want to see something evolve a little farther in your business model, we'll tell you what that is, and you're always welcome to cycle back.
That's awesome. I do want to invite you in the future. We do run winner takes all pitch events, which is a gamified pitch. It's basically startup founders stake $100 on their pitch, and the winner takes the pot.
Oh, very cool.
Yeah, it's kind of a little gamified, and we always say if you can't put $100 on your pitch, how's someone going to put $1 million?
I like it.
Super. We'll make sure that
Yeah,
you're invited to
happy
a future.
participate. Yeah.
All right. The final thing is, when we have interesting guests on the podcast, we'd like you to nominate other interesting guests. We typically talk to either founders or investors in scalable startups. So if you were to nominate someone, who would that be, Dave? Who would you like to be a future guest of the Founders Pack podcast?
Ah, very interesting. I can think of a few different founders of ours that would be great guests, but I would rather not throw their names out.
No. Are they shy?
Well, I don't know if I want to commit them to something that they're not.
That's right. If they say no, they say no.
Yeah, I'm more than happy to
okay.
to email you a few suggestions.
Yeah, that would be wonderful. We'd love to have a couple of them on. Dave, thank you so much for your time today. I look forward to talking to you in the future.
Certainly. Great to be here. Thanks. Bye-bye.